PE ratio, price to earning ratio. If you're someone who is somehow interested in fundamental analysis, I'm sure you would have heard this term. Yes, it is another financial ratio. It is a valuation ratio. That's exactly what we are going to learn in today's video. Because in the last video, I hope you watched it, we have learned about profitability ratios and leverage ratios. Financial ratios, right? So in today's video, the agenda is super clear. We are going to learn about the remaining two different kinds of financial ratios, which are valuation ratios and operating ratios. Cool. So hi all, welcome to the 19th episode of the complete learning series of stock market investing and trading. As always, I've put all these videos into a series. The series is put into a playlist. The playlist is available here in the I button up above. Make sure you watch all the videos in the right order and learn really well. Let's all invest together and grow together. So yeah, we are moving ahead with great pace and with a lot of intent to learn more about fundamental analysis and become successful long-term investors, right? So yeah, the agenda is set. Let's get right into the video. The name is Sharique Samsudheen. Welcome to MarketFeed. Okay, great. Kudos to all of you who are watching this video. I've been saying this multiple times. All of you who are watching are people with great intent to learn fundamental analysis. If you actually keep this spirit alive, I'm sure you'll become great long-term investors for sure. You'll compound your wealth over time. So all the best and congratulations at the very same time. So yeah, mark your attendance in the comment section. Let's start learning. So the presentation is here, up here. I hope you're watching it. So before getting into learning about the ratios that we are going to learn in today's video, let's quickly revise what financial ratios are, why they are used, and different types of financial ratios. Quickly, let's do it. What are financial ratios? As we learned in the last video, if you haven't watched the last video, it is given in the I button up above here, right? Financial ratios are simple numbers which tells us how a company is performing. As simple as that, right? We took an example also. How can we say Sachin Tendulkar is a great batter? We can say not by looking into each innings he played. We just simply say that by looking into his total runs that he scored. We look into the batting average. We look into the strike rate. We look into total number of centuries scored by him. So these are different metrics which tell that he is a good batter or not. Just like that, every company has certain specific numbers, and these numbers would tell if a company is good or not. Cool. So those numbers are called financial ratios. Why is it important? Very clear, right? Because we need to analyze these companies. We need to know if they're good or not. So financial ratios will help us. As simple as that. Moving ahead, there are four types of financial ratios as we discussed in the last video as well. One is profitability ratios. Those are numbers or ratios which talks about the profitability of the company. Number two, leverage ratios. Those are numbers or ratios or metrics which will talk about where the company is standing in terms of leverage, in terms of how much debt they have taken. Are those debt loans good or bad? All of those things leverage ratios would talk about. Now, just revising, refreshing, these two ratios we learned in the last video, and that's exactly why I'm telling you to go and watch the previous video if you haven't. Now here in this video, we are going to learn about valuation ratios and operating ratios. In this, valuation ratios is super important. I'm sure the PE ratio that I said in the introduction, price to earning ratio, that comes under valuation ratio. Talks about the valuation of the company. Is it valued really high? Is it valued really low? Is the valuation good enough to invest? We'll get some basic idea using valuation ratios. Then comes operating ratios. Talks about the operational efficiency, the managerial efficiency of the company. Really good to analyze the company via operating ratios as well. So yeah, the agenda is clear. We're going to learn about valuation ratios and operating ratios in today's video. So the first one we are going to learn is valuation ratios. As I said earlier, valuation ratios help us easily understand how market participants value a company's stock price. We get a fair bit of an understanding regarding the valuation of a company. Is it valued too high compared to the profit that it is generating? Is it valued too high compared to the sales that it is generating? All that is being conveyed by valuation ratios. Cool. So there are three types of, or three large famous valuation ratios which are mostly used by long-term investors, fundamental analysts, and those three valuation ratios are what we are going to learn today. Number one is price to earnings ratio, the very famous PE ratio. Number two is price to book value ratio. Again, a very important ratio. I many times I actually go into tools like a screener and search for companies which falls under a very good price to book value ratio, and those are gem of investing opportunities. We'll talk about that also in today's video. Number three is price to sales ratio. Cool. Let's start learning then. The first valuation ratio that we are going to learn is price to earnings ratio, PE ratio. Let's read through this and you'll easily understand what this is, right? Now, one of the most popular financial ratios, as I've been telling since the introduction, it is one of the most popular financial ratios, also known as PE ratio. This is used for valuing companies and understanding how expensive or cheap the stock is trading currently. Cool. Let's enter into the calculation, the formula, and you'll clearly understand what we are talking about. PE ratio's formula is current stock price divided by earnings per share. Earnings per share we learned in the last video, right? So PE ratio is current stock price divided by earnings per share. Now, yeah, let's actually put numbers and see of Dmart. Dmart's, again, just telling, all of these videos we've been taking example of Dmart to do everything, right? We learned how to analyze financial statements of Dmart. Now, financial ratios also we are doing with the example of Dmart. Now, Dmart's current market price, you can go into any broker's terminal, Zerodha, Fires, Google, right? You can go anywhere and you can find what price is Dmart trading today. So that is 4415 as of today, divided by earnings per share or EPS. Where can we find EPS from? Very simple, right? You can simply go into the P&L statement, profit and loss statement of Dmart, and you can get EPS, earnings per share from here, which is 23.04, right? So 4415 divided by 23.04 is 191. A PE ratio of 191.62. Now let's just understand what this is, right? This means that for every unit of profit generated by Dmart, the market participants are willing to pay rupees 191 to acquire the share. That is, when you as a market participant, when you go into your broker's terminal and buy Dmart's share, when you are paying 191 rupees, that 191 rupees is generating a profit of 1 rupee. 1 rupee profit generation. For generating 1 rupee of profit by Dmart, you are paying 191 rupees. Isn't that a high premium? Don't you feel? For generating 1 rupee profit, you're paying 191 rupees to acquire the share. Now, don't think that when you actually buy Dmart's stock for 4,415 rupees, you're actually going to get 23 rupees in hand. 23 rupees will be the profit generated by the company. That can completely move into the reserves and surplus of the company as decided by the company. It can decide whether or not to pay dividend back to you as a shareholder. So don't get confused here, right? Don't think that when you're paying 4,415 rupees to buy a stock, you're going to get this 23 rupees. No. In case of Dmart, dividend payout is zero. You're not going to get anything. The complete 23 rupees is going to be with the company only. But I hope you get the gist of this. You pay 4,415 rupees and the company with that amount is going to generate 23 rupees of profit only every year. I hope you're understanding what we are discussing here, right? So price to earnings ratio compared to the earnings of the company, where is the price of the company? What is earnings? It's basically net income, profit of the company, right? So compared to the profit of the company or earnings of the company, where is the stock's price? Again, coming back into the example, so for generating 1 rupee of profit, the price of the company is 191 times. So there is a huge premium paid. Now, why is this premium paid? Maybe people believe in the company, believe in the future potential of the company. So they are ready to pay a premium here is what we can see. Now, I'll give you some thumb rules here. A high PE ratio is not that great. A high PE ratio means that the company is valued too high. A company need not be valued too high, right? A low PE ratio means that the valuation is less. A lesser valuation means that it is good for investing, right? I'll give you another thumb rule here. So it's normally said that when you're analyzing a company, it is always good for the PE ratio to be somewhere between 15 to 20 to 30. That is a good PE ratio. Then you might come back and ask me, hey Sharique, if 15 to 20 to 30 is a good PE ratio, then 191 is like out of proportion, right? Is out of world, very high PE for Dmart. Does it mean that Dmart is valued really high? Maybe. And that's exactly where I want to say, when I said that when we learn any financial ratio, it is very important to compare the PE ratio of that company with the PE ratio or with the financial ratio of its peers, right? Of its competing companies. Because maybe some industries it is okay to have high PE. Right. So when I say 15 to 20 to 30, let's not generalize it. Always compare every financial ratio of a company with its peers. Let's do that here. No, let's go into screener. I've already as we saw in the last video, there is a section here saying peer comparison. So PE ratio is added here. So Avenue Supermarts came out at 138. So that's their calculation. And if you see, Trend has a 170 PE. MedPlus Health 148 PE. So as you can see, all of those similar peer companies have PE in the tunes of 100 or above. So what we can understand here is it is okay for this industry, or it is normal in this industry to have a PE of 100 or above. But so that is not what I want you to focus here. I want you to focus on understanding PE, comparing the current price of the stock with respect to the earnings of the company. That is it. Cool. If this is understood, let's move ahead and learn the second valuation ratio, which is price to book value ratio. Now, this is simple. If you understand that price to earnings ratio is comparing the price of the company to the earnings of the company, then what is this? Seeing where the price of the company is standing with respect to the book value of the company. Then the only question is what? What is the book value of a company, right? Now, book value of the company is exactly the shareholders' equity of the company. We've been learning so much. We've come so far. I hope you know what shareholders' equity is. Otherwise, I'll tell that in the simplest way possible. Shareholders' equity or book value is if a company liquidated all its assets today and paid off all its debts, the value remaining would be its book value. Understood? A company decided to shut operations, stop the company. So they liquidated all the assets. They generated money there. Using that money, they paid all its debts and liabilities. Then what would be remaining? That is the actual book value of the company, right? So what we have to find out is book value per share. So that is basically shareholders' equity, which is the book value divided by total number of shares. You know where to find the total number of shares, right? You can simply go into the annual report, easily find total number of shares. So I've done that already. So what is price to book value ratio? Simple, no. Current share price divided by book value per share. Book value per share, I already found out, which is 211.5 in the case of Dmart. So 4,415 divided by 211.5 is 20.87x. Which means, now this last sentence is what you should focus on. That is where you actually understand what PB ratio is, right? So this means that Dmart is trading over 20 times its book value. A high ratio compared to peers would indicate overvaluation, right? So compared to its book value, it is trading at 20 times valuation. The stock price is 20 times of that. Very clear, right? Just like PE ratio, you can simply compare to that. So as you can see here, a low PB ratio, price to book value, is also called a PB ratio. So low PB ratio indicates company is undervalued, which is good. Now, I did say there is a mega jackpot kind of a way of knowing where the company is in terms of valuation, right? That is by actually looking into PB ratio. So you tell me, what if the PB ratio is under 1, is less than 1? What does it tell about the company? It tells that you need to look into the formula here. The denominator is larger than the numerator. And what is the denominator? Book value. And what is the numerator? Current share price. So if the PB ratio is under 1, it means that the book value is larger than the current market price. I hope you are understanding this. The current market price is lesser than the book value per share of the company. Now, what is current market price into total number of shares? Market capitalization. What is book value per share into total number of shares? Total book value of the company. Current market capitalization is lesser than the book value of the company is what it means when the PB ratio is under 1. In that case, if I had all the money in the world, what would I do? I would take that money, pay off the market capitalization, buy the entire company. Maybe practically not possible, but I'm just saying, right? I would buy the entire company. So now I paid my money, I got the entire company. Now the book value is higher than what I paid for. Now what would I do? I would liquidate all its assets, take that money, pay off all its debts. Even then, net money would be left. Correct? Because the book value is larger than market capitalization. I hope you understand. So it is an amazing opportunity. I mean, mostly you can do more due diligence. But again, it is a great litmus test to do if a company has a PB ratio of under 1. It is great. So in this case, anyways, the PB ratio is 20 times, which means that Dmart's price, the current market price, is trading at a premium of 20 times comparing to its book value. Cool? Amazing. So let's move ahead into the next valuation ratio, which is price to sales ratio. Now you understand the exercise here, right? So here you're comparing the current market price of a company compared to its sales that it is doing. So why is this important? Is because always comparing the current market price of a company to the earnings or the profit of a company is not always perfect. It doesn't always give the exact valuation picture of a company. So a lot of time fundamental analysts also compare the price of a company to the sales that it is doing, and that's exactly what it tells. PS ratio is equal to current share price divided by sales per share. How can you find this? You go into the P&L statement, you can find the sales of the company, you divide it by the total number of shares in the company, you'll get sales per share. Just like earnings per share, this is sales per share. And you can get 9.19 in the case of Dmart here. And what does it say? This means that for every rupees 1 in sales Dmart is generating, the stock is valued 9.19 rupees higher. 1 rupee sales happening, the stock is valued 9.19 times higher. So what is it? I mean, simple understanding so far, right? So if the PS ratio is lesser, it is good. It is valued lesser. If it is valued lesser, it's good for us to invest because the valuation can go up in the coming days. If the PS ratio is high, it means that it is already valued really high. Cool. So anyways, these three are the valuation ratios we are learning today, right? PE ratio, PB ratio, and PS ratio. Very simple. In each of the ratios, the current market price of the company is compared to a very critical data of the company. In price to earnings, the current market price is compared to the net income or profit of the company. In terms of profit generated by the company, where is the current market price standing? In price to book value ratio, in terms of the current book value of the company, where is the current market price standing? In PS ratio, in terms of the sales being generated by the company, where is the current market price standing? Is it valued really high or is it valued low? Cool. Very simple, right? Very, very simple. In that case, let's move ahead into even simpler financial ratios, which are operating ratios. So operating ratios indicate efficiency of the company's day-to-day operational activity. It would talk lengths about how well the management is running the company. Is it operationally efficient or not? That is what we'll understand here. These are also called activity ratios or management ratios. Rightly called so, right? Now we are going to learn 4 very famous, very important operating ratios in today's video. Number 1 is fixed assets turnover ratio. Number 2, working capital turnover ratio. Number 3, total assets turnover ratio. And number 4, receivables turnover ratio. Now, I know the names here are a bit complicated, but when you actually hear what they are, you'll feel that they are even simpler than the financial ratios we learned earlier. The very first operating ratio that we are going to learn today is fixed asset turnover ratio. Now, I want you to look into this exact line I'm pointing here, and that will clear in very simple terms what fixed asset turnover ratio is. It tells us how efficiently the company uses its fixed assets like property, plant, and equipment. A single number which will tell us how effectively a company is using its fixed assets. As simple as that. Now let's quickly get into its formula. Fixed assets turnover is equal to operating revenues divided by average of fixed asset. Looking into the mathematical formula, what do you understand? Using average of fixed asset or using fixed asset, how much revenue is the company, operating revenue is the company able to generate? Mathematically, right? Using fixed asset, how much revenue a company is able to generate, how much multiples, right? That is what the formula is. So we are putting operating revenue of the company, easily we can find out from the P&L statement. Then we have to put average of fixed asset. Where can we find it from? Balance sheet of a company, right? So coming into the balance sheet of Dmart, so you come here in under non-current asset, we have property, plant, and equipment, and this is the fixed asset of the company. You take average of this year and last year, basically add that and divide by 2, right? You will get 6,854 crores. So divide these two and you get fixed asset turnover of 4.51. Mathematically, converting this mathematical formula into a simple English sentence is what? This means that Dmart is able to generate rupees 4.51 for every rupees 1 of fixed asset. Every unit of asset, Dmart is generating an operating revenue of rupees 4.51. Good, no? So this is exactly where we said this Fixed asset turnover ratio is a number which will tell how effectively a company is able to generate revenue from its fixed assets. What if this was 100 rupees? We can say that the company is more effective in converting its fixed asset into revenue. What if this was just 50 paise or 0.5? It means that the company is very less efficient in converting its assets into revenue. Cool, as simple as that. So higher the ratio, it means that the company is effectively and efficiently managing its fixed assets. Cool. If this is understood, then you can easily understand total asset turnover ratio, because you can quickly jump here and look at the formula and you can understand what is the formula of total asset turnover ratio. Total assets turnover is equal to operating revenues divided by total average asset. Previous ratio, we took only fixed assets. Here we are seeing the company's efficiency in converting all of its assets into revenue. All of the assets here, here we are looking. So for taking total average asset, we can easily come here. We can simply look at total asset. Right, see total assets. You take the average of 2 years and you put it here. And in case of Dmart, we can see the number is 2.12. What does it translate to in English? This means that Dmart is able to generate rupees 2.12 per total assets of rupees 1. If they have total assets worth 1, they're able to generate operating revenue of rupees 2.12. And it is very simple, just like the last ratio. Higher this is, the more effective, the more efficient the company is. The lower it is, lesser efficient the company is in converting its total assets into operating revenue. Cool? Quickly moving ahead into the third ratio that we are learning today, which is working capital turnover ratio. So in order to understand what this ratio is, we have to first understand what working capital is. I know a lot of you know what working capital is, but let's quickly understand what working capital is. Working capital is the capital required by a company to run its day-to-day operations. Typically inventories, receivables, cash, everything comes under working capital. Now, how do you find out working capital of a company? You basically get into its balance sheet and you take current assets and subtract current liabilities from that, and you will easily get the working capital of a company. Now, I've done that for Dmart and I've got rupees 2,224 crores. So now that is the working capital of a company. Now, just like we did for fixed assets and total assets, working capital turnover ratio talks about the efficiency of a company in converting working capital into revenue for the company. The higher the ratio is, it means that the company is super efficient in converting working capital into revenue. The lower the ratio, it means that the company is not that efficient in converting working capital into revenue. Right. So in case of, let's look into the formula here. Working capital turnover ratio is equal to revenue divided by average working capital. Working capital, anyways, we found out. Revenue we can easily get from the P&L statement. So you divide that and you get 12. Now, what does this mean? This means that Dmart is able to generate rupees 12 by using working capital of rupees 1. If they can manage and handle a working capital of just rupees 1, they can generate revenue worth rupees 12 with that. Amazing. Higher the ratio, better efficient company. Lower the ratio, lesser efficient company. Moving ahead into the final operating ratio that we are learning today, which is accounts receivable turnover ratio. So in order to understand accounts receivable turnover ratio, first we need to understand what accounts receivable are. So we have already learned this in the balance sheet analysis video. I hope you remember it. Anyways, let's quickly revise it. Say there is a company A, and the company A is supplying something to company B. So the company B should pay money to company A, but company B says that, okay, I need this on credit. I will pay back after 6 months. Say this is a 1 lakh rupees transaction. So this 1 lakh rupees becomes receivable for company A, and it is a payable for company B. So this is shown in the balance sheet under receivable for company A, which means that there is a 1 lakh rupee which would come in eventually. Cool. So that is what trade receivable is. So trade receivable and account receivables are basically the same thing, right? So accounts receivable turnover ratio tells or indicates how many times in a given period the company receives cash from its debtors and customers. Very important, no? To know the efficiency of a company. Say there is a company, it has really good revenue, it is looking good, but it is not receiving money into its bank account. Balance sheet is showing good amount of receivables, but money is not coming in. Cash is not coming in, and we have already learned this, right? Cash is king. So it is always important to know how quickly cash is being replenished, how quickly the receivables are actually coming into the company, and that efficiency is what is being measured by accounts receivable. Again, indicates how many times in a given period the company receives actual cash from its debtors and customers. We don't want to see a lot of receivables on the balance sheet. We actually want to see cash in the bank account, right? So high number indicates that the company collects cash more frequently, which is high accounts receivable turnover ratio. If the number is high, it means that the turnover is good, or the company is collecting cash more efficiently and quickly. If the number is less, it means that the company is not collecting very quickly. So the formula is revenue divided by average receivables. Revenue, you know how to take from the P&L statement. Receivables, you can actually go into the balance sheet. You come under assets and see trade receivables, you can see. So so average receivables is what we are taking. You take the average of these two, you put it here, and I got the answer of 562.92x, which means that Dmart receives cash from its customers 562.9 times a year. This is a very high accounts receivable turnover ratio, mostly because of the nature of the business of Dmart. But this is good. This says that the number is high, and the frequency in which the cash is actually coming into the company is really high, and the amount of receivables on its balance sheet is kind of less. Amazing, right? So yeah, this is it. Then we have come to the end of learning about financial ratios. So if you remember, the journey is very interesting, right? First, we learned the importance of long-term investment, why you should be investing into long-term, and where you should be investing and how much you should be investing. Then we understood the importance of actually investing into good quality stocks, finding them ourselves and investing into a great portfolio, right? And for doing that, we understood that we need to learn fundamental analysis, and to do fundamental analysis is why we are doing all this, right? So we understood how to read and analyze and learn the annual report of a company. Then we learned about the three financial statements of a company: P&L statement, balance sheet, and then cash flow statement of a company. But when we did that, or when we learned how to understand all these one report and three statements, we saw that there are a lot of numbers there. Just having many numbers is not helping us analyze a company. And that's exactly where financial ratios came to help us, right? So if that is the case, if you have understood so much, amazing, because even more exciting content is coming your way as part of the next classes. We are actually getting into the crux of the matter. We are going to learn to value companies and actually find out great investment opportunities. So that is what is coming your way. So if you have liked the video, as always, make sure you smash the like button, get into the comment box, ask questions, download MarketFeed app for great trade ideas of profitability verified India's top traders. You can learn from them as well, or you can even join my exclusive community where I conduct regular live Q&A and discussion sessions. So that is it. As I always ask, do share the video with many people, invite them into our growing, learning, amazing stock market community, right? So yeah, that is it from my side for this video. As always, let's learn, trade, invest, and grow together. See you in the next class. Bye-bye.